Most people will lose money in 2026, not because markets are rigged, not because inflation is unfair, not because they weren't warned. They'll lose money because they repeat the same mistake they've been making for years and they still refuse to admit it. People like to believe losses come from bad timing, from unlucky cycles, from forces outside their control. That story feels comfortable because it removes responsibility. But comfort is expensive, and in finance, it's usually fatal. I've watched multiple cycles play out. Booms, crashes, recoveries, resets, different headlines, same behavior. Every time, the same group gets hurt. Not beginners, not professionals. The middle, the confident amateurs who think knowing a little is enough. The uncomfortable truth is this. Most people don't lose money because they don't know anything. They lose money because they think they know enough. Enough to ignore risk, enough to skip discipline, enough to assume the future will behave like the recent past. That mindset is exactly what breaks people when conditions change. 2026 isn't dangerous because of one specific event. It's dangerous because of positioning. People are positioned wrong, mentally and financially. They're exposed in ways they don't understand, and they're overconfident about risks they haven't measured. When markets are calm, mistakes stay hidden. When money is easy, bad decisions feel smart. Rising prices mask weak strategy. That's when habits get reinforced. That's when people confuse luck with skill. Then the environment shifts. Costs change. Liquidity tightens. Growth slows. Volatility returns. And suddenly, decisions made years earlier start demanding payment. This is where excuses show up. People blame central banks. They blame governments. They blame institutions. But the losses don't come from policy announcements. They come from exposure that was never managed in the first place. The core principle most people ignore is simple. Risk doesn't disappear just because it hasn't shown up yet. It accumulates quietly, invisibly, until it's forced into the open. Most people are not prepared for that moment. They are overextended, overconfident, overleveraged. They've structured their finances for a version of the world that no longer exists. Cheap money forever, stable growth forever, upward trends forever. That's not how cycles work. People talk about long-term investing, but behave like short-term speculators. They chase returns without understanding downside. They buy because prices are rising, not because fundamentals make sense. They assume time will fix mistakes, ignoring the fact that time magnifies bad positioning as much as good strategy. This is where most financial failure actually begins, not at the crash, not at the headline, but years earlier when discipline was optional and caution felt unnecessary. The mistake people are making right now is not preparing for change. They're building financial lives with no margin for error, no buffer, no flexibility. Everything depends on things going right. That's not investing. That's hoping. People earning decent incomes feel safe. They assume income equals security. It doesn't. Income without structure is fragile. The moment income slows, stress appears. Decisions worsen. Forced selling happens. That's how losses get locked in. The middle class is especially exposed. Enough money to invest, enough access to credit, enough confidence to take risks, not enough protection when conditions turn. They think diversification means owning several things that all move together. They think long-term means ignoring risk. They think volatility is something that only matters to traders. It's not. Volatility exposes behavior. It shows who planned and who assumed. Wealthy investors don't fear downturns. They plan for them. They structure portfolios so bad years don't force bad decisions. They hold liquidity when others chase returns. They protect downside first because upside is meaningless if you can't stay in the game. Most people do the opposite. They maximize exposure during good times and panic when conditions tighten. That's not bad luck. That's predictable behavior. Another excuse people use is age. Younger investors assume time will save them. Older investors assume it's too late to change. Both are wrong in different ways. Time only helps if decisions are disciplined. And change is always possible, but only if denial ends. The financial system doesn't punish ignorance, it punishes arrogance, the belief that rules no longer apply, that fundamentals don't matter, that risk can be ignored because recent performance feels reassuring. Every cycle ends the same way. People who respect risk survive. People who dismissed it explain their losses afterward. The mistake isn't a single bad investment, it's a mindset. a refusal to adjust when conditions change, a belief that what worked recently will always work. That belief is expensive. People are currently positioned as if stability is guaranteed, as if growth will cover mistakes, as if debt is harmless, as if liquidity will always be available when needed. That's not how real markets behave. The warning signs are never subtle, they're just inconvenient. Rising costs, slower growth, tighter credit, increased volatility. None of these are surprises, they're signals. Signals most people ignore because reacting would require discomfort. So they do nothing, and doing nothing is still a decision. By the time consequences show up, options are limited. Selling feels painful, adjusting feels late. That's when losses become permanent. This is not about fear. It's about awareness. The people who lose money in 2026 won't be the ones who lack information. They'll be the ones who refuse to act on it. In the next part, we're going to break down the specific behaviors people are engaging in right now that feel normal, responsible even, but are quietly increasing their exposure to loss. Behaviors that look harmless in calm conditions and destructive when volatility returns. Most people won't recognize themselves in it at first. They never do. The mistake most people are making right now doesn't look like a mistake. That's why it's spreading. It looks responsible. It looks rational. It looks like what everyone else is doing, and that's exactly what makes it dangerous. People are building their financial lives around recent conditions instead of durable principles. They are assuming stability where there is none. They are optimizing for returns while ignoring resilience. Let's start with exposure. Most people don't know what they're exposed to. They think exposure means stocks versus cash. It doesn't. Exposure is how sensitive your life is to change, interest rates, income stability, market volatility, credit availability, inflation, liquidity. If any one of those shifts and your finances tighten immediately, you are exposed. And most people are exposed in multiple directions at once. One common behavior is concentration disguised as diversification. People own several investments that feel different but react the same way under stress. When conditions are good, everything rises together. When conditions tighten, everything falls together. That's not diversification. That's correlation blindness. People tell themselves they're diversified because they own multiple assets. They don't ask whether those assets fail at the same time. That question gets ignored because asking it would force uncomfortable adjustments. Another mistake is treating debt as neutral. People assume if they can afford payments now, they're fine. That logic ignores timing. Debt compresses future choices. It forces fixed obligations into an uncertain environment. When income is steady and costs are predictable, debt feels manageable. When either shifts, debt becomes a constraint, and constraints remove options precisely when flexibility matters most. People are currently carrying more leverage into uncertainty than they realize. Mortgages at the edge of affordability, consumer debt normalized as lifestyle support, margin exposure misunderstood as opportunity. All of it assumes tomorrow will resemble today. That assumption is fragile. Another behavior is performance chasing. People move money based on recent returns, not long-term logic. They buy what has already gone up because it feels safe. Rising prices create confidence. Falling prices create fear. This reverses good strategy. Wealthy investors do the opposite. They reduce exposure when risk is underpriced and add exposure when fear is widespread. That requires emotional control. Most people don't have it because they've never practiced operating against the crowd. Instead, they rely on narratives. Stories about innovation, stories about long-term inevitability, stories that justify holding risk without managing it. Narratives are comforting. Numbers are less forgiving. Another mistake is ignoring liquidity. People invest everything. Every dollar is working in theory. In practice, it means no buffer. When volatility arrives, they're forced to sell at the wrong time to meet obligations. Liquidity is not wasted money. It's strategic flexibility. It allows patience. It allows choice. Without it, people become reactive. Reactive decisions lock in losses. Most people underestimate how quickly forced selling happens. It doesn't wait for perfect conditions. It happens when pressure arrives. Job changes, expenses spike, markets drop simultaneously. That's when plans fail. Another behavior that feels normal is confusing optimism with strategy. People assume markets will recover because they always have. History is misused here. Markets recover over time. Individuals don't always have the luxury of waiting. Time only helps if you can stay invested. If cash flow pressure forces exit, long-term recovery becomes irrelevant. This is why structure matters more than predictions. People also misunderstand risk tolerance. They think tolerance is emotional. It's not. It's structural. If your lifestyle depends on uninterrupted income and stable markets, your tolerance is low, regardless of how confident you feel. Many people claim high risk tolerance during good times. That confidence disappears when volatility tests it. That's not hypocrisy, that's miscalculation. Another mistake is ignoring opportunity cost. Capital tied up in fragile positions can't be redeployed. When better opportunities appear, people are stuck defending old decisions instead of adapting. They hold because selling would admit error. They wait because waiting feels safer than acting. Meanwhile, conditions change. There's also a dangerous belief that information equals preparation. People consume financial content constantly: news, opinions, predictions. They mistake awareness for action. Knowing risks exist is not the same as preparing for them. Preparation requires adjustments. Adjustments require discomfort. That's where most people stop. The wealthy think in terms of survival first, growth second. They ask how they lose before asking how they win. Most people do the reverse. They ask how much they can make and ignore how much they can lose. That difference compounds. This mistake is ongoing. Right now, quietly, every month people reinforce fragile structures. Every year they delay adjustments because nothing is broken yet. That's how risk accumulates unnoticed. By the time markets force recognition, the mistake feels sudden. It isn't. It's been building for years. In the next part, we're going to look at where this leads if nothing changes. Not a dramatic collapse, something more common. Gradual erosion, missed recovery, locked-in losses, and the regret that follows when people realize they had time to adjust and chose not to. If nothing changes, the outcome isn't a crash. It's something slower and harder to notice. Erosion. Most people imagine financial failure as a single event, a collapse, a headline, a sudden wipeout. That's rare. What's far more common is gradual loss, missed upside, locked-in mistakes, recoveries that happen without you. The first consequence is that people don't lose money all at once. They lose it by being forced to act at the wrong time. They sell when pressure is high. They stop investing when prices are low. They reduce exposure when risk is already realized. None of that feels irrational in the moment. It feels necessary. That's how losses become permanent. Opportunity cost is the invisible damage. While capital is stuck defending fragile positions, it can't move to better ones. While people wait for old decisions to come back, new opportunities pass by. That gap compounds quietly. Time plays a critical role here. Compounding doesn't just reward good decisions, it punishes delayed correction. The longer a mistake remains unaddressed, the more future effort it demands to overcome it. People assume time is on their side. It isn't by default. Time amplifies whatever structure you've built. Strong structure improves with time. Weak structure deteriorates. Another long-term consequence is emotional exhaustion. Living with constant financial pressure drains judgment. People become defensive about their choices. They avoid reviewing accounts. They stop adjusting. Avoidance replaces analysis. That's when denial sets in. People tell themselves it will work out eventually, that patience is a strategy. It isn't. Patience without structure is just waiting. Waiting doesn't protect capital. As years pass, flexibility declines. Income becomes harder to replace. Risk tolerance shrinks. The ability to recover from mistakes narrows. People who failed to manage downside earlier are forced into conservative positions later, not by choice, but by necessity. That's when regret appears. Not loud, quiet. People realize they took risks without understanding them, that they ignored warnings because nothing had gone wrong yet, that they mistook stability for safety. Another consequence is dependency. When assets don't produce resilience, people depend entirely on continued income. That dependency increases stress. It limits options. It forces compromises. Financial independence doesn't mean stopping work. It means not being trapped by it. The mindset that needs correction is subtle. People think control comes from maximizing returns. It doesn't. Control comes from minimizing forced decisions. The fewer situations where you must act under pressure, the stronger your position. Small decisions matter here. reducing leverage, holding liquidity, adjusting exposure gradually instead of reactively. None of this feels urgent in calm conditions. That's why most people delay it. But calm conditions are exactly when adjustments are cheapest. Wealthy investors don't wait for certainty. They wait for asymmetry, situations where downside is manageable and upside is meaningful. That requires patience and discipline. It also requires saying no to situations that look attractive but weaken structure. Most people do the opposite. They chase excitement. They follow narratives. They stay exposed because reducing exposure feels like missing out. Missing out hurts emotionally. Losing money hurts structurally. One is temporary, the other compounds. If nothing changes, most people won't be wiped out. They'll just fall behind. Inflation will outpace growth. Recovery will lag peers. Years will pass without progress. That's the real cost, not ruin, stagnation. In the final part, we'll talk about responsibility. What actually needs to change in how decisions are made, risks are evaluated, and money is treated. No predictions, no shortcuts, just principles that work across cycles. At some point, awareness has to turn into responsibility. That's where most people stop. Not because they don't understand the problem, but because acting on it requires admitting they were positioned wrong. This isn't about blame. Blame is useless. Markets don't care who you blame. Responsibility means recognizing that your financial structure either protects you or exposes you. There is no neutral position. The first change that has to happen is mental. Risk is not something you react to. It's something you plan for in advance. Waiting for confirmation is how people get trapped. By the time risk is obvious, it's already priced in and options are limited. People need to stop asking whether something will go wrong and start asking what happens if it does. That shift alone changes decision-making. It forces people to look at downside, not just upside. The second change is structural. Income, expenses, debt, investments, and liquidity must work together. When one area is stretched, the whole system becomes fragile. Many people have built lives that only function under perfect conditions. That's not resilience. That's exposure. Reducing exposure doesn't mean exiting markets or hiding in fear. It means aligning risk with reality. It means understanding how much volatility you can actually tolerate without being forced into bad decisions. Liquidity matters here. Cash is not a failure of imagination. It's a tool. It buys time. It buys patience. It prevents forced selling. People who dismiss liquidity usually learn its value during stress, when it's already scarce. Another adjustment is reducing leverage. Debt narrows choices. It accelerates outcomes in both directions. In uncertain environments, leverage magnifies mistakes faster than it magnifies success. Discipline means using leverage sparingly and intentionally, not casually. People also need to separate confidence from certainty. Confidence is acting within your plan. Certainty is pretending risk doesn't exist. One is strength, the other is denial. There is no perfect forecast. There never is. Waiting for clarity is not a strategy. The goal is not to predict 2026 perfectly. The goal is to avoid being fragile in 2026. That requires incremental adjustments, not dramatic moves. Small reductions in exposure, gradual improvements in liquidity, clearer limits on risk. These changes don't feel exciting. That's why they work. Wealthy investors don't overhaul everything at once. They rebalance, they reassess, they adapt quietly, they don't wait for permission from headlines. Another critical responsibility is emotional discipline. Fear and greed are always present. The difference is whether they control behavior. Systems exist to remove emotion from decisions. Rules, allocations, limits. Without those, every decision becomes emotional under pressure. People who lose money usually say the same thing afterward. They didn't think it would happen to them. That belief is the real mistake. Markets don't target individuals. They expose assumptions. The assumption that nothing will change, that trends will continue, that risk can be ignored. The reminder worth ending on is simple. Money follows behavior. Not intelligence, not intention. Behavior. If your behavior assumes stability, you're exposed to instability. If your behavior respects risk, you survive it. Most people will lose money in 2026 because they refuse to adjust before they're forced to. A smaller group will protect themselves quietly by acting early, without drama, without certainty. The difference won't be luck, it will be structure. That's the reality.